Ever wondered how G10 currencies move in relation to emerging market currencies? And what about the hidden link between the US dollar CNH and Euro US dollar? Stick around because today we're breaking it all down. Let's start with the basics. G10 currencies include major ones like the US dollar, euro, yen, pound, and Swiss. On the other hand, emerging markets or EM currencies include the Brazilian real, South African rand, Turkish lira, and the Chinese yuan. But how are they connected? One major factor is risk sentiment. When the market is in a risk-on mode, meaning investors are willing to take risks, emerging market currencies tend to gain value as money flows into higher yielding assets. But when things turn risk off, like during economic uncertainty, investors flee to safety, strengthening G10 currencies like the US dollar and the Japanese yen while pushing emerging market currencies lower. The US dollar plays a massive role in this correlation. If the Fed raises interest rates, the dollar strengthens, making it harder for emerging market economies to repay US dollar denominated debt. This often weakens emerging market currencies. But if the Fed eases policy, the dollar weakens, which supports emerging market currencies by reducing capital outflows. Then there's the connection through commodities. Emerging market currencies like the Brazilian real, Mexican peso, South African rand often move alongside commodity-linked G10 currencies like the Australian dollar and the Canadian dollar. If global commodity demand drops, maybe due to a strong US dollar or economic slowdown, it impacts both the EM and G10 currencies. Dollar yuan, China's offshore yuan versus the US dollar, often moves inversely to euro dollar. Why? Because both pairs are largely driven by the strength or weakness of the US dollar. If the US dollar strengthens, maybe due to Fed tightening, US dollar yuan rises because the yuan weakens, while euro US dollar falls because the euro also weakens against the dollar. The opposite happens when the US dollar weakens. China and the EU are major trading partners. A slowdown in China's economy can negatively impact European growth, indirectly weighing on euro US dollar. And don't forget risk sentiment. If the market is in panic mode, investors rush into the dollar, leading euro US dollar down and US dollar yuan up. But in a risk-on environment, dollar weakens, meaning euro US dollar up, dollar yuan down. So, what's the takeaway? If you trade forex, understanding these correlations can give you an edge. Watch how risk sentiment, the Fed, and global trade influence currency moves. Do you want to see real-time examples and live chart analysis? Let me know in the comments. Don't forget to hit that like and subscribe button and turn on notifications for more forex insights. Thank you for watching.